How's it going, everyone? This is Nick from eVenture Consulting. I'm super excited to be back with yet another market deep dive coming to you each Wednesday with a data-driven look at a new market for real estate across the US. And today I'm super excited to bring you Raleigh, North Carolina. I gotta say, guys, the Raleigh-Durham Metro, this has probably been the most requested market deep dive city that I've had in the last couple months. I know a lot of you are excited, whether you're an investor or home buyer, about buying real estate in Raleigh, and for good reason, because Raleigh's actually been in the news a lot lately. You might have seen that Apple just announced that they're going to be building a big 3,000 employee, $500 million campus in the Research Triangle Park just outside of Raleigh. That's going to bring a lot to the local economy and potentially a lot to the local real estate market. So I understand why you guys are excited about Raleigh from an investment standpoint. So what we're going to do in this video is two principal things. The first is, from a more general level, we're going to evaluate Raleigh and ask the question, is now a good time to buy or is now a good time to sell? Do we think that here in mid-2021 that prices are going to go up in Raleigh over the next couple of years, or are they going to go down? The next thing we're going to do, number two, is take a more detailed look on a neighborhood by neighborhood basis, looking at the data in a more granular fashion so you can find the specific locations in Raleigh that are the best to buy in mid-2021. You're not going to want to miss either of these things. So whether you're a real estate investor, a home buyer, maybe you're just moving to the Raleigh area, this is going to be a great video for you to watch so you can learn more about the city. Without further ado, let's get into it. So guys, the first place we got to start is just getting a sense for how much does real estate, how much does a home cost in Raleigh, and how has that changed over time, and how does it compare to the US average? And that's what we're looking at on this graph, where the blue line represents the typical price of a home in Raleigh over the last 25 years or so, and the gray line represents a typical price of a home in the US over the same time span. And this data comes from Zillow. It's their typical home price index. And in Raleigh, across the metro, we can see that as of April 2021, which was the most recent data that Zillow has available, typical home price of $327,000 in Raleigh. And that's about, let's see, that's about 15% higher than it is in the US average. So Raleigh's a little more expensive than the US, but to be honest, it still looks pretty cheap, especially compared to all of the growth that it offers. And we'll get more into that later, just all the growth that's going on in Raleigh. Now, if we look historically, we can see that Raleigh's actually been a pretty stable real estate market over the last 25 years. Its typical home price back in 1997 was $171,000. That went up to $232,000 before the last housing crash. And then there was a little dip in Raleigh after the crash, about 10 to 15%, but not too much of a dip. You can see that US home prices in general went down by a lot more. So Raleigh historically is a more secure market. And then over the last 7 or 8 years, we've seen pretty strong appreciation, especially over the last year or so. You can see this line has kind of gone almost vertical. Now, the one thing I want to call attention to on this graph, guys, is the long-term appreciation in Raleigh. Because we started $171,000 here in 1997, and we're at $327,000 today. While on the surface, that might seem like kind of a big jump to go from 170 to 327, over 25 years, it's actually a really low appreciation rate. Raleigh's long-term annual home price appreciation over the last 25 years, over the last quarter century, is 2.7% per year. So that's right. If you were to grow 171,000 by 2.7% a year over 25 years, you get to 327. And that 2.7%, that's actually right around inflation. So homeowners in Raleigh over the long term do about as well as the rate of inflation. Now, this is kind of curious, right? Why does Raleigh have such poor long-term appreciation? Why is it basically just sitting at the rate of inflation? That doesn't seem right, given how the city is a growth magnet, right? Like lots of jobs going to Raleigh each year, lots of migration. It's a big tech city. Incomes are high. It feels like prices should be going up by more than 2.7% per year over the long run. What's the deal? Well, this is actually more of a supply issue in Raleigh. And it's due to the fact that Raleigh builds more new homes and apartments pretty much than any other city in America. So if you go to Raleigh, it's not a market that's constrained in terms of new building. There's tons of new building going on. And when you have tons of new building going on, it's going to be hard for price appreciation to really kick into that next gear that's going to deliver big returns to homeowners and investors. And you guys can see what I'm talking about on this graph. where we're looking at a metric that I call jobs to permits ratio. And this is taking, over the last decade, the number of jobs that these metros have added that you see on this list and dividing it by the number of permits that were pulled for the construction of new homes and apartments. Because really it's this relationship of economic growth, jobs, to housing supply, permits, that determines the appreciation potential in the long run. If you guys are enjoying the data presented in this video, just please hit that like button. That will help me out a lot, gets me a bit more exposure on YouTube, and actually allows me to produce more of this content going forward. So just hit that like button. And additionally, make sure to leave a comment. I want to hear what your experiences are in the real estate market, especially if you're in the Raleigh, Durham, or North Carolina area. What are you seeing as a potential buyer, seller, or renter? When you guys comment, it makes these videos better. All right, let's get back to the video. And if we start at the top of this list, you can see we have San Francisco, which added 322,000 jobs over the last 10 years, but only pulled 123,000 permits, a ratio of 2.6 jobs added for every one housing unit. Right, so just think about that. In San Francisco, they're adding almost 3 jobs, 3 people working, but only adding 1 housing unit. You could see very quickly how in that situation, you would end up with huge price appreciation. And that's something that we've seen in San Francisco over the last decade. We go down the list, we can see Sacramento's 2.3, Miami is 1.8, Phoenix is 1.7, and really this red dotted line, 1.5, that's kind of equilibrium. 1.5 jobs for every 1 housing unit. That's a market that's in a balance. It's not in a housing shortage. It's not in a housing glut. But then let's go a little further down this list. We have Nashville, which is right at that 1.5. Austin, which is at 1.2. Then we have Raleigh down here, which is basically 1-to-1. And 1-to-1 is not good for appreciation. That means we're building, you could almost say, too many new homes and apartments for how much the economy is expanding. Right? And it's this 1-to-1 in Raleigh compared to say 1.8-to-1 in Miami or 2.3-to-1 in Sacramento. It's this 1-to-1 in Raleigh, which really explains why its appreciation has been so low. And it's important that you guys start thinking about housing supply in this way. Structurally, how many units are getting permitted and built versus how many jobs are being added, how many people are moving to the city. That is what determines your housing supply, housing shortage dynamic. A lot of people like to focus on a metric called active inventory or months of supply on the market as somehow an indication of supply. Ignore that. All that is a snapshot at a single point in time. It doesn't tell you anything in the long run about what the supply dynamics in a market are. So what you want to do is compare job growth to permitting. And in the case of Raleigh, it doesn't look so good. And that explains why its appreciation over the long run is pretty low. Now, on the other hand, the fact that Raleigh builds so much new housing is a good thing for the city in general, right? It might not be the best thing for selfish real estate owners, but it's a good thing for the city in general because it means prices are going to stay at least semi-reasonable. They're never going to get to this California level of appreciation because to get to that level, you need to have a big shortage in how much you're building. Raleigh, it's building more than enough new housing, which means prices and rents are going to stay reasonable in that city. That's a good thing for Raleigh in general, and it's a good thing for the overall growth of the city in general, because if it stays affordable, then businesses are still going to want to move in, people are still going to want to move in, and less people are going to feel like they need to move out. So on the positive note here, Raleigh's huge amount of building, yeah, it's lower appreciation, yeah, it's lower values, but it makes for a more sustainable long-term growth story than maybe a place like San Francisco or Sacramento, which is now dealing with a big outward migration because prices got so high. So, you really need to think of this in a dynamic way. And I would say the one real benefit to Raleigh right now is that even in mid-2021, when we're in a housing bubble, and that housing bubble is going to come crashing down at some point soon, Raleigh still offers good value for home buyers and investors, right? It's not a market where you're going to buy into and expect crazy appreciation, but it's a market where I think you can expect pretty good downside protection from the next housing crash. I don't think Raleigh is going to be a market that's going to get hit that hard. And you guys can see what I'm talking about on this graph where we're taking a look at a metric that I call value to earnings ratio, which is the typical home price in the market divided by the annual earnings of the typical worker. And the home price data comes from Zillow. The earnings data comes from the Bureau of Labor Statistics. And what we have here is Raleigh in the blue line. And we can see in April, Raleigh was at a 6.2 value to earnings. The typical price was $327,000 compared to annual earnings of $52,000. Now let's compare that to a market like Austin, which is spiked all the way up to 8.0. So in Austin, the typical home price is $442 compared to annual earnings of $55,000. So what this means is that Austin on a relative basis is a lot more expensive for the locals that live there compared to Raleigh. And this is a metric that you really need to pay attention to in mid-2021 when we're in a big housing bubble, right? And values are inflated almost everywhere. You need to ask the question, when the bubble bursts, what are the markets that are going to be able to absorb, right, that fall better? And a place like Raleigh will absorb that fall better than a place like Austin, because locals in Raleigh still have a chance at today's prices of affording a home. Locals in Austin do not. And this is the key, guys, right now in mid-2021 is risk mitigation. We're in a housing bubble. Prices are at all-time highs in most markets relative to wages and rents. So we need to be risk mitigators, right? And if in a market values are more closely aligned with wages, that market is less risky. How do we know this? We can go back to the last housing crash, 2007 to 2012. What were the markets that got hit the hardest? Those were the markets where values were much higher than wages. What were the markets that didn't get hit at all? The ones where wages and values were more closely aligned. And Raleigh is more of the latter, right? Wages and values more closely aligned. Austin is more of the former. So I like Raleigh right now from the perspective of security. Not to say that prices won't go down in Raleigh, but they're unlikely to get hit by 20 or 30% in the same way that a market like Austin is exposed to. Now, with all of that said, real estate is local, right? We're talking about the Raleigh-Durham metro area. That's a big, big place. There's pockets where you probably do want to invest right now. There's pockets where you probably don't want to invest right now. And the best way to get a sense of this is by looking at zip code by zip code granular data on things like price appreciation, home values, demographics, to give you a real sense of what's going on the ground at the local level in Raleigh. And the first thing we're going to look at is quite simply home prices. Where are the expensive areas? Where are the more affordable areas? This lays the bedrock of understanding which neighborhood you should target as a home buyer or investor. So guys, on this graph, we're looking at every zip code in the Raleigh-Durham metroplex. And you can see that, we're covering a big geographic area here, right? So there's a lot of different places in Raleigh that you could buy a home or invest in. And the color coding is this. The more purple or magenta the zip code looks, the higher the home prices. The more gray the zip code looks, the lower the home prices. So for instance, you can see we have this deep purple zip code 27608 right in the center of Raleigh. Typical home price of $724,000. That's really high for Raleigh. But if we were to go out to, for instance, 27576 in Selma in Johnston County, the typical home price is $173,000. So this gives you a perspective of like the range in home prices. Now, if we zoom in, we can see that there's a lot of purple here just kind of to the north of downtown Raleigh and then to the west, right? So let's start with 27608, which we just talked about. That's a neighborhood called 5 Points, the most expensive neighborhood in Raleigh. And actually what I like about this zip code is I was on Zillow looking at places in the zip code. And there's a bunch of $1 million homes, but there's actually, I saw a new build on there, 2,400 square feet for $550,000, which I thought, probably kind of maybe expensive for a new build in Raleigh in general, but to be in a neighborhood like this, I thought it was pretty good because I've looked at a lot of other markets, and to be in the best neighborhood on a new build at $550K, that shows a certain level of affordability that doesn't exist in other cities around America. So take a look at 27608. This is really the preeminent zip code in Raleigh. If we go west to 27607, this is starting to get closer to where some of the universities are. So we're right to the north of NC State in this zip code, and then we also have Meredith College and a veterinary college in this zip code as well. So we're seeing prices here at $521. Typical home price, which are also kind of elevated. I was looking at listings in this zip code, and you can find like recently renovated homes around 1,700 square feet for $350,000 to $400,000. So again, I was kind of impressed with the level of affordability that exists in these higher price zip codes in Raleigh. You would not see this in, say, the high price zip codes in Austin, that type of affordability. Now, if we zoom out, we can see that Another area with high prices would be Chapel Hill. This is where Duke is to the west. Then we also have Cary. 27519 in Cary also has high price, and look at that median household income of 133,000. That's really high. So I actually really like that relationship of home prices to median household income in 27519. Now, if we zoom out and go north, you can see there's a lot of more cheap prices in Durham the further north you go. So if you do want even more affordability, you can go up to Durham, or you could go out to some of these more rural zips if you really want to kind of test the waters and find something cheap. Just be warned, the more rural you get, especially in a bubble, the more risk you face in terms of declines in prices. Now, the next thing we're looking at here, same map, except the color coding is now showing the appreciation rates in these zip codes over the last 5 years. And you can see that the map is basically flipped. Like all the areas that were magenta before are now gray, and the areas that were gray are now magenta. What that means is it's the lower price zip codes in Raleigh that have seen the most appreciation over the last 5 years, while the higher price zip codes haven't done as well in appreciation. And this is something that is typical of many cities and markets in America. You'll see this in a lot of my deep dives. It's the cheaper, often more poverty-stricken areas that have had higher appreciation. That's largely because investors pile into these areas during expansions and bid prices up. So if we take a look at Durham, you can see Durham is going nuts. 75% appreciation in downtown Durham over the last 5 years, 27701. If we go to 27704 just to the north, we see 67% appreciation. So these two zips in Durham are really the all-star appreciation zips. Then if we go to downtown Raleigh, we've seen 54% appreciation, and then just to the east in southeast Raleigh, 27610, we've seen 58% appreciation. So this gives you a sense, guys, of like where the lay of the land is in terms of growth in Raleigh over the last 5 years. Now, I would caution you guys against simply chasing recent appreciation and growth. That can be a dangerous strategy and mentality at the peak of a bubble, because often it's those high appreciation, more poverty-stricken zip codes that tend to get hit hardest when the crash occurs. So one thing you're going to want to do is, in addition to looking at this data, you're going to want to look at things like income levels and income growth, and then increase in college degrees in these zip codes, because that's going to signify if there's actually real gentrification and real growth that's occurred, rather than just real estate speculation occurring. So guys, in summary, Raleigh is a market I think is a little overhyped right now in terms of future growth expectations. A lot of people see Apple moving there and they see all the colleges and they think that, oh, we're just gonna have runaway appreciation. When you look at the historical data, Raleigh is not that type of market. It's a slow and steady market. Doesn't appreciate too much, doesn't decline too much. And to be honest, in 2021, that's exactly the type of market you probably want to target. You don't want to be in a market with crazy swings in appreciation. Raleigh, they build a lot of new housing, which is good for society at large, problematic for real estate owners since you're probably not going to see those next levels of appreciation. But the affordability in Raleigh is going to mean that the city is just going to keep growing. So I like it from a really fundamental standpoint. Just check your expectations in terms of how much you're going to appreciate if you do buy there. And once again, guys, like I say at the end of every video now, using data is so important right now in mid-2021 because we are in a housing bubble. It is going to come crashing down, and you really need to understand what you're getting into in terms of local markets and local neighborhoods before you buy. There's a lot of people out there who are trying to sell you a dream, whether they be local realtors or investors or coaches, or trying to get you all hyped up into spending money at the peak of a real estate market. It's not that you shouldn't buy a property now, it's that you need to just make sure you know what you're getting into. Right? So use data. It's really, really important. If you want help using data, you can reach out to me at www.reventureconsulting.com. I do one-on-one coaching where I help people figure out the markets that are best for them based on their investment strategy, as well as the local neighborhoods that best fit their investment strategy. So if you're serious about buying a home or an investment property and you want to use data, go to www.reventureconsulting.com, submit a contact form. There'll be a link in the description. When you submit that contact form, just make sure to leave a decent description about what you're doing in real estate and why you think coaching and data will help you. If you guys like the data I presented in this video, just make sure to hit that like button. Hitting the like button gets me a bit more exposure on YouTube, helps me out a bit, helps me actually produce more of this content. So hit that like button. Also comment. I want to hear what your experience is as a home buyer or renter right now, especially if you're in the Raleigh, Durham, or North Carolina area. What are you seeing out there? When you guys comment, it makes me more intelligent, makes these videos better. Additionally, make sure to subscribe so you don't miss this going forward. We have 2 to 3 videos per week. On Sunday, we have a video coming out out, analyzing if BlackRock is actually taking over the US housing market. I'm sure you guys have seen a lot of news articles on this. We're actually going to look at the data and find out whether it's fact or fiction. Is BlackRock taking over the US housing market? So you're not going to want to miss that. Until then, guys, this is Nick from Reventure Consulting signing off.